Hello and welcome to BQ Prime. A very good morning to all the viewers. I am Hiral Dadia. One stock that is in focus in today's session is the Thermax on the back of Q1 earnings that have been reported with a growth of almost around 16 to 17% in terms of the top line. In terms of the profitability, if you see the adjusted PAT, the number stands at 142 crores, and overall, it has been impacted due to an exceptional item of the provision related to litigation of around 51 odd crores. Order inflows around 2,570 odd crores, and the order book stands at 10,500 odd crores. Joining us on the show to discuss more is Ashish Bhandari, Managing Director and CEO at Thermax. Ashish, good morning and welcome to the show.
Good morning, Hiral. Pleasure to be here.
Always a pleasure to speak to you as well. Ashish, my first question coming to you is, in terms of the numbers, have they met your internal expectations?
Yes, I think the numbers both on the orders and on the revenue, given our backlog, is a lot more in our control. And on the profitability side, I would have liked us to do even better than what we did. And this leaving aside the one-time exceptional charge that we took. Even besides that, I would have liked us to do better than what we ended up doing. Yeah, satisfied on the orders side, would have liked to see a little bit better on the profit side.
Right. So, Ashish, the provision related to the litigation of 51 odd crores, when does that overhang actually get resolved according to you?
We don't know. Could be a year, could be a few years. A lot we will know also based on we are making a submission to the High Court, what the initial response from the High Court is. And then from that point on, it starts again. So we don't know. Could be a fairly long time.
Right. Overall, if we see the gross margin number, that has expanded on a lower base, which we had seen in the first quarter of FY23. And that was, again, owing to the adverse impact of commodity inflation. Overall, how are you seeing the margin picture? Because clearly, the street was estimating somewhere in that range of 7.5%. We have seen a growth, but not as much as what the estimates were looking like. And the other expenses have been higher this time around. What would you attribute that to?
So overall, I would say couple of things here. First, on the margin side, as I said also, I would have liked to see better margins. There are portions of our business which were quite consistent. Our industrial products, our chemicals business, even the green solutions business were relatively stable. Yeah, and mostly according to plan. It is on the project side where we had a couple of big projects that were going through their final stages. And many of them have got discussions relating to final LDs, release of provisions, final bit of negotiations with customers, etc. as those provisions get released. Some of those discussions and some of that final closure on a couple of those projects was more complicated than it should have been. Yeah, and the end result was that in our industrial infra business, the margins were below our expectations. The industrial infra, as I've said previously also, is the place where there will be some amount of volatility, both on the orders side. When you get big orders or you don't get orders in a particular quarter, there would be some amount of volatility. There'll also be a little bit of volatility on the margin side, where margins, when particular projects go through certain parts of completion, they could influence the overall results for the segment. All that said, my current expectation is that Q1 was especially difficult, and in future quarters, we should start to do better and look better, even on the industrial infra side.
Right. Overall, the order inflow, that has remained quite healthy. We've seen 11% growth coming in there. From here on, which segments do you think will be, the contributors to a stronger order book? Because currently it's still ruled by refinery, petrochemicals, metals, and steel. I mean, both of them are above 15%.
So for us, our bigger projects tend to come from these segments. Yeah, and it is this intersegmental shift which drives what happens on our big orders. Historically, our biggest orders over the last few years have come from refining which is where we've come back with 500, the sulfur recovery unit of almost 1,000 crores, those kinds of projects, and from power, which is where we were doing the FGD projects. Both of these right now are, we don't see anything which is over 500 crores. And I've been saying that for a couple of quarters. That said, we see a much more broad-based strength that we see showing up in steel, in cement, and even in terms of refining. While we may not have really big projects, we've got several small to medium projects that we are bidding on, many of which are not even greenfield, they're brownfield-based expansions, which make sure that our overall pipeline is reasonable. Yeah, there's nothing, and I've been saying that, yeah, I've been bullish on the Indian economy, bullish on a multi-segmental recovery, and I've been saying that for some time now.
Right. So overall, as you mentioned about steel, you mentioned about cement, etc., with the increase in the government capex as well on infrastructure, along with that, we are seeing the focus coming in on ethanol blending as well. How are you seeing that actually help the company's various segments of business, especially if you take sugar distillery into consideration, or for that matter, cement? How much will the contribution grow according to you?
So both of these are already big parts of our growth story. Yeah, and the entire ethanol, the entire biomass to energy portion, and I call this as agro waste in a way, because what you're taking is bagasse, and whether it's 1G or 2G, depending on the technology, you're taking either agro waste or agro itself, product itself, and converting it into energy. And we have had fair bit of share in providing the power plant relating to those applications, the energy conversion, etc., providing some of the core equipment. We are working in bio-CNG, which is one more, it's an adjacency to the ethanol space. And not only providing equipment, looking to do overall EPC as well. So this whole ethanol market has been a big portion of some of the numbers that we have delivered. And that is partly why I've said we don't see big orders, but we see a lot of smaller orders, and the ethanol market is an example of that. Similarly, cement, waste heat recovery, and how multiple cement plants started adding waste heat recovery plants. And that has been going on for the last 3 years. Much of the waste heat recovery plants on brownfield project activity is now complete, but some of the bigger cement plants are now adding new greenfield capacity. And the waste heat recovery as part of that greenfield capacity means that cement continues to have a decent pipeline going forward as well.
Right. So overall, if you see, from a order perspective, what's the kind of revenue visibility that we have? And secondly, what's the bid pipeline looking like?
The overall bid pipeline is healthy, but it is not growing at the rate that it was for a year and a half in between. Yeah, where we were seeing the pipeline grow substantially. The pipeline is now, because at that one point in time, we had a big refinery pipeline, and we also had many of the other segments continuing to grow. Right now, we have our overall inquiry pipeline continues to be extremely high from a historical standard, but it is not going up at the rate it was going previously. Yeah, but it is continuing to be healthy, continuing to be keeping us extremely busy. And also, as I said, the segments now of steel in particular, a lot of the other ancillary businesses also, we finally have projects relating to even carbon capture, variety of very different kinds of projects than we did in the past. Very, very busy overall as a company.
Right. And if I was just looking at the order balance, industrial infra and chemical segments has been marginally lower, and you mentioned that it's due to execution of orders in Q1, which have been lower. What's the reason for that?
So I'll break industrial infra, nothing but just based on customer asks and how the projects are scheduled, because these are big lumpy projects. They go through depending on when the deliveries are scheduled and all that. So it doesn't have as much uniformity. but the backlog is good. There are no particular projects that are on hold or anything. So they will clear in their due natural process as well. Chemicals, I think on the volume side, we did not do as well as I would have liked us to do. Yeah, and we have committed that chemicals volume has to grow and continue to build that profitability and volume growth of chemicals. And that is something we're still committed to doing. In Q1, we found, because in our chemicals business, more than 50% is exports. In Q1, the US market in particular was muted. Yeah, and many of our customers took less volumes than they typically do. Much of the business is repeat business as well. So there we did not do as much as we would like to. Yeah, and in future quarters, we want to get that volume growth going again in chemicals, because that is a big part of our long-term growth story for Thermax. Yeah, so we would like to see that chemicals growth rate coming back on.
Right. And Ashish, my last question coming to you is in terms of FY24, what's the kind of growth we are envisaging and aiming at?
Look, we should have a decent year, both on revenue, reasonable on profitability, on orders. What I can see in front of me gives me confidence, but because we don't have big orders, some of these smaller orders that you see good strength in, but you can actually commit only for a quarter or two. So the whole year as such would be difficult for me to say right now. I would say, reasonably bullish, but would like to continue to see month over month and just keep our eye on the ball. Yeah, just keep focusing on what's in front of us. Make sure that we are doing what is meaningful, which is being a trusted partner to our customers as they go through energy transition. And I think as we do that, India expands, the green agenda continues to build out. I think the orders will take care of themselves.
Absolutely. So that's something the street will be looking forward to as well. Thank you, Ashish, so much for joining us on the show. Always a pleasure to speak to you. Stay safe and speak to you soon again.
Thank you. Thank you, and wish you the best as well.